Testing, testing, 1, 2, 3. Testing, testing, 1, 2, 3. Testing, testing, 1, 2, 3. Testing, testing.
Good morning, everybody. This is Joshua Tan, the Head of Research, and welcome to our Monday weekly webinar. Okay, so the agenda today will start off with a weekly market outlook, some macro fundamentals, and then we'll move on to views of our Singapore equity strategists, and then we'll be featuring Pan United Corp, which is a stock that we initiated on the 24th of December. And after that, we have Q&A, which whereby you can ask questions on anything related to Singapore equities, and we'll try to answer them. Okay, so let's start. The STI has had a fine run of about 10% since mid-November, so you see that strong move there. On the 23rd of November, in our morning note, we actually indicated that the investment climate was getting better, and we're getting increasingly more positive on the first half of 2013. Okay, so that was around here, and since then we have it's been in line with a strong rally. Okay, so now the question is, will it continue? If you look at the last two candlesticks on Thursday and Friday, on the top right of the screen, they're actually a bit indecisive, okay? However, that's not the end of the story, so let's move on to the context that it is in. Now, Asia ex-Japan has also had two indecisive candlesticks on Thursday and Friday, which suggests perhaps there might be some stalling ahead. However, the US had a strong close on Friday, reversing an indecisive Thursday, at the key, and it's very close to the key 1470 resistance. Okay, it does suggest that the S&P is going to push higher, and so at the time of writing of these slides, we thought that Asia would probably take some encouragement today, which seems to have been the case, as the STI is up about 1/3%, and the Hang Seng and China is up as well. Okay, so the good news was that Friday's non-farm payrolls was solid, and that overwhelmed Thursday's indecisive doji, which was due to the Fed minutes indicating that QE might end sometime this year. Okay, so short-term outlook aside, we are progressively positive for 2013. The investment outlook, we think, is getting better. There might be some short-term volatility in the February of this year. Okay, underlying fundamentals are positive. Macroeconomic indicators are bottoming out in the US, China, and Asia. Now, the US might suffer some drag in the first half of this year because although the fiscal cliff was watered down, it's still from a 4% hit to a 1% hit to nominal GDP. So that is still a hit to GDP of 1%. So there's going to be a little bit of a drag. However, investment is making a comeback. Housing is strong, employment growth is moderate, and income growth is returning. So we think the second half growth for the US will be stronger. China is bottoming out. The only question is, how strong will this rebound be? At the moment, reform is in the air, and we think that could be catalytic to addressing China's underlying inequality, and could be pretty good for markets around about the second quarter of this year. ASEAN growth is going to moderate, but it will still be supported by a strong infrastructure boom. And Singapore is itself undergoing a very strong infrastructure boom, and our call on Pan United is in line with that. There's going to be some increase, well, rather moderate acceleration of growth this year to 2% from 1.2%. last year. Inflationary pressures persist. Monetary policy is pretty accommodative, and QE is still on the cards and will be on the cards until unemployment goes below 6.5 or inflation expectations are unhinged. Now, there is some uncertainty to this now because in the Fed minutes, some members actually expressed reservations on the effectiveness of QE and are worrying about how the Fed will exit vastly increasing balance sheet. So that's one key uncertainty for this year. The second one is, of course, the sequester that is coming up this February, and that is about 1.2 trillion worth of spending cuts over 10 years, which will be debated. Okay, so those two are key uncertainties. However, we believe the overall investment climate is getting better. STI third quarter earnings was actually in line, and earnings momentum and valuations are favorable. Now, on that note, I'm going to pass you on to our Singapore equity strategist, Derek, who will elaborate on that.
Good morning. This is Derek here speaking, Singapore equity strategist. Most of the things that I talk about today can be found in our Singapore equity strategy report. We call it 2013 Market Outlook, released in December 2012. So these are the contents, things I'll go through today. First, I'll start off with various valuation and momentum indicators, and we'll do some updates on our research publications for the week. Finally, I will end off with the top picks for Singapore market in 2013. To start off, the first indicator that we look at is the earnings momentum trend in the Singapore market. Sequentially, for most of 2012, earnings momentum have been contracting, and we found that earnings momentum actually hit an inflection point in September in 2012 at around minus 19%, as you can see in the chart on the bottom right-hand corner. Well, this is counterintuitive, but we believe that the inflection points at the bottom of the momentum trends is they are all actually bullish indicators for the market. As you can see, previously, all negative inflection points are actually occurred near to the market bottoms. Earnings momentum have actually turned positive in around 6% sequentially. Equity risk premium in Singapore market remains fairly high. We calculate equity risk premium by taking the STI's earnings yields and less of the bond yield in the Singapore market. The current level of equity risk premium is still high at around 5.5%, 0.8 percentage points higher than its 7 years average of around 4.7%. We believe that this fear in the market could actually ease off in the year ahead, and with the normalizing of equity risk premium, stock market should drive higher in the year ahead. Thirdly, we compare the valuations of the Singapore markets against the GDP trend in Singapore's economy. We found that there's a positive correlation between the valuations on the price-to-book value multiples and these GDP growth numbers. PSR's macro analyst, Valuation actually expects GDP growth of around 2% in 2013, which is consistent with price-to-book value multiples of around 1.5 times. Compared to the current level of 1.4 times, this indicates that valuation multiple still has room for expansion in the year ahead. The fourth one, we look at the historical valuation numbers. Current valuations in the Singapore market is around 1.4 times on book value and 12 times on the trading earnings. The average market price-to-book value multiple on the last market cycle is around 1.6 times, and PE is around 15 times. That indicates that current level of valuations are still below historical means. Also, and that means that mean reversion is still possible for the Singapore market. Now, let's look at the historical components of market returns. In the early stage of the market cycle, market returns tends to be accounted for by expansion on the multiples when we look at the PE basis. As you can see in 1999 and year 2009, the long dark blue column there actually indicates the repricing in terms of multiples re-rating. And subsequently, earnings tend to grow at a faster pace and multiples will contract in the year after that. We believe that 2013 will probably be comparable to 2005-06 period, where we have low earnings growth and fairly moderate multiples expansion. If you use the Grinnell and Connell's model, we think that a 24% return to the Singapore market is a possibility in the year ahead. Let me just say that this number is not an absolute return target. Let's just say that we think that this is a likely return number based on historical trends. But for more tactical recommendations on the Singapore market, we advise our clients to look at our daily market commentaries, which provides up-to-date market outlook on the daily basis. Research updates for the week. We published several research reports. The first one, our research analyst actually updated on the risk sector on the last trading day of Singapore of the 2012. We found that it's a bumper year for S-REITs, and we still think there's still upside to the S-REITs in the year ahead. Approximately 8% price return in 2013 based on another 30 basis point of yield compression, and that would lead to a double-digit return after dividends are accounted for. Our REITs analyst also like Suntec REIT, which is not covered by our team, but we find that the valuations of this REIT is attractive relative to its closest peer, Mapletree's Commercial Trust. We resumed coverage on Capital Corp as well, and updated the contract wins for the company for the year 2012. Overall, we think that the long-term offshore and marine prospects are still positive, and the robust demand means that we have a positive view on this company. We also updated on the banking sector, where we observed a double-digit loan growth numbers for the total DBU in November 2012. We prefer UOB over DBS and OCBC. We also updated on the Macau Gaming sector. Overall gross gaming revenue in Macau actually increased by 13.5% month-on-month and close to 20% on year. We think that the data could have a bit of an upside bias due to the festive and holiday season. We like Galaxy and Las Vegas Sands in this sector. Lastly, we also released an update on the global macro asset strategy, which is elaborated separately in this presentation by Joshua. So now for the top picks in our Singapore market for 2013, the three companies that we recommend to our clients are SI Engineering, CapitaLand, and Pan United. SI Engineering, we believe that SI Engineering is a key beneficiary of the aviation growth story in the region. Over the next decade, a large number of planes will be delivered into the region, and hence demand for maintenance work is expected to increase. We also expect SI Engineering to benefit from the record aircraft orders by Singapore Airlines Group. Furthermore, we think that the economic modes in the engine maintenance joint ventures have not been fully appreciated by the market and could be a source of upside to future earnings. We believe that when you look at this company, you should really look at the free cash flow generating nature of the business, which allows them to consistently pay high level of dividend to shareholders. We have a target price of $5 on this stock. The second one, CapitaLand, is covered by Brian, our property analyst. CapitaLand is one of Asia's largest real estate company with a portfolio diversified across countries and asset classes. It is one of the world's leading service residence owner and operator. It also has a very strong proven track record as a property manager and a property fund manager. Now, despite having been in acquisition mode for the past 2 years, its financial capacity remains strong and is ready for further acquisitions. It has a strong pipeline of assets that could be divested over the next few years, and we think that it is actually a beneficiary of a bottoming out of the China's economy, with 1/3 of its assets located in China. With that, I'll hand over to Joshua, who will talk about Pan United Corp, which is the company that featured today. Thank you.
Thanks, Derek. Okay, we initiated on Pan United on the 24th of December last year when it was, it was actually at 71 cents, not 70 cents. Again, it's with a price target of 88 cents and a forecast dividend payout of 4 cents for the coming year ahead. So that was a total return of 29% based on 88 plus 4 cents, 92 cents. Okay, so to give you some background on Pan United, it was actually founded by Mr. Ng Kar Chiong in 1958 and is presently run by his children since the 1990s, and it's a well-known old hand in the Singapore business scene. It started out in the shipping and shipbuilding business in the 70s and 80s, but in the 1990s it diversified. Okay, so it's got a strong presence now in basic building materials, which form 90% of profit after tax and minority interest. And that business has 1/3 market share in both cement and ready-mix concrete in Singapore. The second jewel in the crown is Ports and Logistics Division, which has a 51.3% stake in a top 10 river port in China called Changshu Xinhua Port, which is in the Yangtze River Delta, and this contributes close to 1/3 of PATMI. Now, there is still remains of the initial business, the first business, which is the shipping fleet, and it's a small fleet of about 10 tugs and barges, and which actually has been loss-making. However, we do think that this year is break-even. The shipping fleet is retained because it synergizes quite well with the basic building materials division. Okay, so we initiated on 24th of December, and the impact of the report was immediate, with the stock rallying 10% in 4 days. So right now it's consolidating at 80 cents, so there's still about 15% more upside to our price target, plus forecast dividend. Okay, so the investment highlights of Pan United, there are 3. Like I said, the first, basic building materials. Okay, the construction outlook is very, very bright. There is a strong visible pipeline of public works till 2019 as Singapore struggles to close the infrastructure gap after a decade of population expansion. And like I said, BBM commands 29% of cement and 33% of ready-mix concrete in Singapore. And the main highlight is that given there's such a dominant supply in the scene, why bet on individual contractors which are competing for contracts when you can just bet on the dominant supplier, which will probably supply them all? The second investment highlight is ports and logistics. Okay, CXP has a compelling combination of location, depth, and size, okay, in sealing its competitive advantage. It also has strong EBITDA margins of about 50%, and should grow with and earnings should grow with China's economy. There's a potential catalyst of its by the fact that 38% of the port is owned by Macquarie Infrastructure Fund, which has completed a strategic review. Okay, I'll go into these in more detail. This is the initial summary. Okay, the third investment highlight of Pan United is that it has a very strong value creation track record. It really shows you the money going by what it's done over the past 10 years. Okay, the Ng family has a strong track record of monetized value creation. Since 2001, when the share price averaged 27 cents, Pan United has thus far rewarded shareholders with 961 million or $1.74 cash per share in distributions to date, which includes 313 million of dividends and a 648 million shipbuilding exit payout after the shipbuilding business was spun off via distribution in specie. So, including a 162% increase in share price since 2001, the total return works out to be a staggering 22% annually. So we think that the company's ethos of competitively positioned businesses, balancing growth and throwing off cash, is aligned with public shareholder interests. Okay, so let's just go into more detail on Pan United. Let's just start with the Port and Logistics Division. Okay, it is in the Yangtze River Delta and has a captive audience, being closest to the Suzhou Wuxi Changshu industrial area, which comprises 20% of China's GDP. It is also the furthest west port on the southern bank capable of accepting fairly large vessels of up to 100,000 deadweight tons due to its depth of 13.3 meters. It has a reasonably long berth length of 1.7 kilometers, which means it can dock several such large vessels. It also occupies 1 million square meters of land and over 100,000 square meters of warehouse space and 600,000 square meters of yard space. Okay, this provides ample storage capacity and room to grow that capacity given the land space. Currently, it's operating at 75% capacity. So it's got a good balance of location, depth, and size, which means that fairly large ocean-going ships can go as far west as possible, dock, unload, pick up all at once without having to rely on small service ships, right? Unlike ports further upstream, and does not need to unload in phases or in multiple locations, all of which encourages pilfering, time and inefficiencies, and logistical added costs. Okay, so that's a map there of where CXP is, and that's the triangle, industrial triangle that we're talking about. Changshu, Wuxi, and Suzhou, and CXP is closest to that triangle. Given such a strong competitive positioning, we think this port will continue to be a money printer for the group. Okay, so you look at the financials of the port and logistics. You see EBITDA margins are close to 50%. Cash flow of event generations is extremely strong. EBIT margins are close to 40%. Okay, it's not every day you get an asset like this which has a strong competitive advantage. It's working capital and capex light. And the bonus kicker is that since Macquarie Infrastructure Fund has declared publicly that they will sell their 38% stake, Pan United has right of first refusal, which can potentially add 1.2 cents to earnings per share if they do buy over that chunk. Okay, on investors' minds, whenever you do an acquisition, is will there be a rights issue? Okay. Now, we don't think there's much chance for there to be a rights issue, and we will be very surprised if there is a rights issue. We think that any acquisition will be cash or debt financed. Okay, this is because Pan United has extremely strong free cash flows. If you look at the core operating level, it's consistently positive. Free cash flow, core free cash flow, which is listing off all the capex requirements for expansion and maintenance. You see for the past 3 years we have strong free cash, and it's on a rising trend. And also if you factor in the investments of Pan United, you see that the overall free cash flow is consistently positive, far outstripping the amount of dividends that they are paying at the moment. Okay, so we got strong free cash generation. The balance sheet is already in net cash position of close to 12 million. Shareholders' equity is about 350 million, which is about 3 times the valuation of the 38% CXP stake. So we think a cash debt finance acquisition more likely. At the end of the day, it's going to be about price, and I think Pan United will probably want a reasonable price for the stake. To buy the stake, sorry. Okay, now let's move on to shipping. Okay, this is the part where some people question, why doesn't Pan United simply just sell off the shipping part? Because first of all, it's quite small and it made a loss last year. Okay, this just gives you some background. Pan United originally found its value creation in shipping and shipbuilding. Okay, shipbuilding was spun off into a separate listing in 2004 via distribution in specie to its shareholders, and then it sold the entire business for 648 million, reaping enormous returns for shareholders. Okay, now it's got a remaining fleet of 10 tug and barge pairs, which transport gypsum, coal, sand, and other building aggregates in the Southeast Asia region. Therefore, apart from being a third-party transport provider, forms an integral part of the value chain for basic building materials. Okay, the case in point was that during the 2007 Indonesian sand ban, the shipping fleet was swiftly deployed to transport sand from non-traditional sources, and that allowed the BBM division to take advantage of the sand spike and basically sell more ready-mix concrete at rather inflated prices. Shipping, therefore, cannot be easily dispensed with, as it is an integral part of VBM's value proposition. Nonetheless, at the bare minimum, it should be maintained at break-even rates so as not to destroy shareholder value. At this, management guides that the focus is therefore to improve utilization rates versus route optimization and fleet downsizing. So it has done so by selling 3 pairs of tugs and barges last year for a 2.2 million gain, and so reduced the fleet. So the guidance is that losses at the EBIT level have been reduced significantly, and 2012 is expected to break even. Now we move on to basic building materials, which is the main driver of earnings for the group at 90% of PATMI. Okay, it is the market leader in cement and ready-mix concrete in Singapore, at 29% and 33%. The sheer market presence gives exposure to Singapore's large infrastructure and construction projects without having to take bets on individual contractors. 60 billion alone has been set aside just to double the current MRT network. The government is currently undertaking a large number of projects: Tuas West MRT extension, Downtown MRT, LNG terminal, Sports Hub, Marina Coastal Expressway, Pasir Panjang Newport facilities, the Ng Teng Fong Hospital, HDB, BTOs, and Pan United has supplied them all. Okay, so if you look at the listed space of Singapore construction stocks, many people ask us, why don't we recommend individual contractors? Well, we say that what's the point or rather it's more advantageous to bet on the dominant supplier than to take bets on individual contractors who may or may not win the project. Okay, BCA currently estimates that demand will be between 20 to 28 billion per year for 2013 and 2014. More than just over half of which will be from public projects. Okay, public projects that are about to start in 2013 are the Singapore Power Cable Tunnels and Changi T4, and at the same time there's actually going to be quite a bit of private sector construction for 2013, which includes South Beach and Marina 1, which is a $7 billion developmental project. So going to 2013 and 2014, there's a hefty amount of private residential, office and shop floor space that is being constructed, that is under construction or unstarted. So if you look at the charts on the right, this is residential. The blue line, you can see what is under construction and started is close to multi-decade high, and we have a nice upswing here for office, shop, and factory supply, which is similar to the 08-09 peak. Okay, beyond 2015, the demand for basic building materials still looks good because the announced but unstarted public works pipeline sounds just as hefty. There's the Thomson MRT, which is $18 billion worth, East Regional MRT, North-South Expressway, Sengkang General, community hospitals, and then there's the eventual relocation of all city port facilities to Tuas Megaport, followed by the redevelopment of the entire city coastline. And that is a huge project in waiting. It implies that demand from 2015 should remain firm with a very conservative baseline of 20 billion a year till 2019. The National Population and Talent Division reckons in its 2012 paper that Singapore at 5.3 million people is under-infrastructured and that 5 to 10 years of building is required to restore capacity. Now, what more that the target population has already been hinted by the Prime Minister's 6 million. That's 700,000 more than the 5.3 million. And so we think that so long as Pan United maintains their 1/3 market share, it's almost a foregone conclusion that it will continue to have exposure to just about all these upcoming major projects. So volumes for VBM is going to be strong, but what about price? For this, we have to think about what does it take to make ready-mix concrete. Okay, it's a mixture of aggregates of sand, gravel, and stone, cement, water, and chemical additives. The composition of inputs under certain conditions and its application method can be technically demanding depending on the complexities of the project, which may demand specialized concrete. Now, the value chain stretches from raw materials, sea transport, warehousing, production capacity, and network, and technical expertise to produce specialized concrete. And as infrastructure and buildings are built to last, litigation risk associated with failure, contractors tend to minimize risk by relying on very well-known suppliers with strong track record for timeliness, reliability, and technical expertise. Okay, if you look on the, I got a bit ahead of myself there. I would just want to explain to you the on the charts on the left-hand side. It basically shows that if you look at the bottom chart, the size of the ready-mix concrete market corresponds quite well to Pan United's basic building materials earnings before interest and tax. And if you look here, we have the demand for ready-mix concrete has been rising quite a bit, while the share price has been rather steady. Okay, so that implies that overall market value is expanding. Okay, so we talked about all these things on ready-mix concrete and what it takes to be a ready-mix concrete supplier. So how does Pan United square up? Okay, so ready-mix concrete technical demands can range from setting time, temperature control, texture, reinforcement, element resistance, porosity, strength, density, and flexibility, to name a few. And Pan United is a market innovator in Singapore with 200 different types of concrete products to date. And it's backed by years of field data collection and a team of R&D engineers. Okay, it's a so it's as a recognized leader in RMC innovation and quality with a significant public and private track record. It has a significant edge in bidding for higher margin complex projects. For example, the interlace. It has an extensive network of production facilities to ensure timeliness of distribution and operates a cement terminal at Jurong Port with 2 dual cell silos. And as an operator of tugs and barges, it gives reliability to access to raw materials. And it also owns 2 quarries in Malaysia and Indonesia, which supply 3 million tons per year of aggregate, which is well, less than a third of the total amount it needs. So in terms of the entire value chain, it's got quarries, sea transport, cement terminal, production network, track record, market innovation. It is pretty much a vertically integrated player, more so than most. Now the key risk here is that global ready-mix concrete players like Cemex and YTL enter the Singapore market aggressively and challenge Pan United. Okay, we also want to show that Pan United has pricing power in ready-mix concrete. During the 2007 sand ban, ready-mix concrete spiked with the price of sand. So if you look here, the blue line is concreting sand that spiked. Ready-mix concrete spiked with no discernible time lag, and this was how Pan United was able to actually expand EBITDA margins and EBIT margins in 2007. Okay. At the same time in 2007, during the sand ban, when the price of sand spiked, the share price of Pan United spiked as well. So I think what we really want to say is that because usually when you talk about RMC companies, people are worried about the possibility of the lack of aggregate and political concerns in other countries. Well, I think the first thing you have to notice is that so long as you can get sand, if one country bans sand and you can deploy a shipping fleet to get sand from somewhere else, you can at least still sell ready-mix concrete and make some money at the same time. The other thing I want to point out is that if you look at the price of ready-mix concrete well, for the last 2 years, it's actually diverged higher away from concreting sand, which has been going lower. So a check with management tells us that, a check with management shows that there's actually upward adjustments of the price of ready-mix concrete, along with other non-sand variable costs, which I think is reassuring for margins going ahead, which are nonetheless expanding. If you look here, EBIT margins have been pretty much on have expanded for the last year, and EBITDA margins as well. Okay, the entire, the 9-month results for Pan United has surpassed the whole of 2011, and so we think that for 2012, given the current earnings momentum, and we think that the fourth quarter actually economy has picked up, we see no reason why this earnings momentum should not continue. And I think for the full year, we have forecasted that earnings come in at 8 cents, which is quite a bit higher than last year's 5.5. And there's quite a high chance that dividends will be raised from 3.5% to 4%. Okay, currently Pan United is trading at 4.4% yield based on the 3.5% payout. However, given what we think is strong earnings, cash flows, I mean, as you can see, 9 months has already surpassed the entire 2011. And given a 50% payout ratio, which is actually lower than the 62% 5-year average payout ratio, we think dividends could be raised to 4 cents for FY13, if not FY12. Okay, so at 80 cents, which is the current price, the forward dividend yield is 5%, which is still 50 basis points away from our FY13 target of 4.5% dividend yield. Okay, target price 88 cents. Now, if you look at how we derived this, was that the ST Small Cap Index is trading at 4% yield right now. Okay, and when we initiated this, Pan United was actually trading at closer to 5% yield, and we reckon that it should not be 93, more than 90 basis points away from the average yield of the STI small cap index, and so we gave it the midpoint, which was about 4.5%, which was between 4 to 4.93 or something, now where it was at. And given our 4 cents dividend yield payout, gave us the price target of 88 cents. Okay, so, and as you can see that Pan United is already on a re-rating trajectory. If you look at the green line here, the yield has been falling steadily. Now it's at about 4.4, and but the small cap yield is still at 4, so there's still a bit of a spread there. Now we think that given the 4 cents dividend projection and what we think is a reasonable 4.5% yield, will give a price target of 88 cents. Now, I just want to finish with the ending remarks on this stock. Is that price target aside, I think it's important to focus on what really matters. Pan United has a very good track record of paying dividends, and dividends that grow over time, which is the mark of a strong underlying business. And if dividends are growing, it's also a very compelling re-rating force, which means capital gains as well and strong price rebounding characteristics in the event of a huge market sell-off. And this is the kind of company that potentially rewards time in the market rather than timing the market. Okay, thank you. So we have our standard disclaimers, and you can ask questions right now. Our whole team is here, so actually you can ask questions. Okay, the first question is, shall we buy in the Singapore equity market now or wait for the debt ceiling issue to be resolved? Or wait for a pullback? Yeah, it's a difficult question to answer because if you look at the way the market is trending right now, the market is just being very positive. It's positive in the sense that it's assuming that all this fiscal, all these sequesters will be resolved. Okay, and if you want to wait, I think they will. The way the market psychology right now, it does seem to suggest to me that some upside will be lost if you choose to wait, because the market is just going to price in a resolution to it. Now, our baseline also is that that there will be a resolution. at the end of the day. Of course, there is the outside risk that it may not happen, and in the event it does, in the event we have an ugly finish to the U.S. sequester, do bear in mind that the underlying fundamentals in ASEAN are strong and China's bouncing back. And so we do not expect a sell-off to be catastrophic. Okay, we have more questions here. Okay, well done for Pan United, thank you. Is it still worthwhile to buy in now or weighing the risk reward? If not, what is a good entry price? Yeah, good question. I mean, the run-up has been pretty strong. I would say for questions like that, yeah, I mean, you know, if you look at the chart, it's consolidating at 80 cents. And it doesn't seem to suggest to me that it's going to have a sharp reversal before it climbs higher again. So I think at 80 cents it's reasonable, yeah, to look for to look for an entry point. And also the thing I want to emphasize about Pan United, it is a value builder over time. Okay, so even if you buy at 80 cents and then let's say there is some kind of macro event and there is a sell-off, you know, I think, you know, stay focused on the fact that free cash generations are extremely strong. Dividends are very likely to be raised over time. Okay, we have a question on REITs. On the preference between Suntec REIT and Mapletree Commercial Trust, I'll pass you to Travis.
Hi, good morning, everyone. I'm Travis. Regarding the questions on the reasons for our preference of Suntec REIT over Mapletree Commercial Trust, when it comes to valuations, we think that the Mapletree Commercial Trust, which owns the Vivo CD, is a good comparable for Suntec REIT due to the asset geographical location and the type of property, as both REITs own commercial properties, retail and office property assets. At this juncture, Suntec REIT is trading at a discount of roughly 18% to its NAV, while Mapletree Commercial Trust is trading at a premium of 24%. We think the Suntec REIT valuation is undemanding, even though the MCT is related to Temasek Holding with a strong pipelines of our property to be acquired from Mapletree Investment Private Limited. In times to come, we strongly believe that Suntec City is well positioned to capture the higher traffic volume and retail sales and eventually translate to a higher rental income. Thus, we prefer Suntec REIT for its undemanding valuation with an attractive yield of 5.8% at current price.
Hi, Joshua back again. Okay, we have a few more questions on Pan United. Basically, they relate to the labor costs that contractors are facing for government policies, and are they able to pass this on? Basically, well, if you look at the slide that I showed you just now, if I could go back to it actually. Okay, if you look at, can you see it? Yeah. It's okay. I'll just. Okay, to basically look at this this chart here. You see the price of ready-mix concrete, which is the orange line, which is trending higher. Okay, and you have the price of concrete sand, which is trending lower. And management tells me that that is actually an adjustment for non-sand costs. Okay. Because typically you would think that, you know, if the price of sand is coming down, you can also adjust your RMC price downwards, but actually they're adjusting RMC price upwards for the past 2 years to take into account all these non-sand variable costs. Okay, so I think although it is a concern, you know, at least we have some comfort that they are able to pass on some of the costs. Okay, there's one more question on Pan United regarding the shipyard ship repair business. Okay, that's a business that they sold away already. So they disposed of that in 2007 and returned about more than 600 million worth to shareholders. So I'll pass you back to Derek for questions on the Singapore market.
Hi everyone, this is Derek here speaking. We have some questions on which sectors in the Singapore market that we will recommend entering at the moment. Well, I think that is a difficult call now to pick specific sectors because a lot of the sectors that are doing well are actually fairly valued, while those which are not doing well are fairly cheap at the moment. So I don't think it is time to make a sector call yet. So we have two themes that we recommend for 2013. The first one is that dividend themes will remain in focus. The flight to high yielding dividend stocks will likely remain in the focus for 2013 in the year ahead. With that, you can refer to our strategy report where we detail the list of all the companies that could pay out higher dividends over the year ahead. The second theme that we recommend that clients get exposed to is the construction sector, which we think that Pan United is the top stock to be in at the moment. Lastly, this is not in our report, but if you wish to trade the rebound in the trade cycles and bottoming out of the trade cycles in the near term, we think that we have a positive view on NOL as well as Singapore Airlines, which are highly correlated to the economic movements in the global markets. All right, that's all that we have today. Thank you very much. Do stay tuned. Join us next week. Thank you.